Hi, everyone. Can you hear me? Yes. Great. So I'm so very honored to be here and to talk to you about technology. Not the technology that you all use and we've heard so much about today, but about the structure of technology. Stuart talked this morning about the fact that real options aren't applied because we lack structure. Well, we actually lack a theory of structure. And so what I'm going to present to you today is a theory of technological structure that applies option theory, and I'll show you how it does. I don't think it can be used as the basis for prices because the probability distributions are very hard to estimate. I do think, well, in the Q&A part, I can talk about what I think you can observe about option structure in the economy. You basically have to map the connections between tasks and transfers. And if you do that in a design structure matrix, you will see blobs. Those are things that can't be broken apart, have to be priced as one unit. And you will see thin crossing points if you have a modular structure. And those thin crossing points are where you will get transactions. But that's actually a different talk. I want to say that I took 15415 from Bob Merton in 1971. That was 52 years ago. I think I was Leslie and Judy both, we overlapped, but we didn't know each other. So I wrote my undergraduate thesis on convertible preferred stock in the spring of 1972. And then I went to Harvard Business School, probably a bad choice. But there it is. And I just gave you the high-level intro. I want to show you how real options influence organization design and industry structure, which is something of interest to some people in the room, but many not. So I apologize for that in advance. This is a puzzle. Andy Grove noticed in 1996 that the whole computer industry had undergone a massive shift in structure, where before 1995, or in the period 1985 to 1995, firms had started out being vertically integrated, standard early 20th century model, IBM the biggest, Digital Equipment, Sperry, Univac, all vertically integrated. With the advent of the IBM PC and I'll talk about what it did, we saw a fragmentation of the industry. It split apart to become a platform ecosystem. Actually, many platform ecosystems, the biggest of which was Wintel. So why? And why the transition? Why then? Why that industry? So I'm going to talk, there really are two puzzles here. The first is large vertically integrated corporations in many industries arose in many industries in the late 19th century, and they were it for the theory of technology for about 100 years. Lenin called it the commanding heights. They were the epitome of big business, high technology. They disrupted the social order of the time. They set a new social order. But they were also seen as very progressive, scientific, rational, innovative, welfare-enhancing, open to talented individuals, and able to get things done. And this went under the heading of mass production. My question is, why did big business and the modern corporation succeed and become dominant in the late 19th century? And why was there a vertical to horizontal transition in the computer industry in the late 20th century? So why, and where will each type of organization prosper? So I want to start with flow production processes, and I'm going to propose a new type of option. I promised Stuart earlier today. The late 19th century, it all descends from Adam Smith's pin factory. 18 steps in a particular order carried out by 18 people equaled a lot of pins, the division of labor. Fast forward to 1913, the first moving assembly line, same idea, step, 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 step. At the end of a whole bunch of steps, out pops a product with value to users, in this case, the Ford Model T. But automobiles were not the only industry to be overtaken by this type of production technology, this process. So in these processes, all steps are essential. Strict order of steps is not necessary. Think of carrying out a recipe. That's the structure. It imposes some constraints. Not only on automobiles, there's a whole of steel, oil, food, paper, rubber, sewing machines, electrical equipment, farm equipment, cans, explosives, department stores, mail order companies, all became flow production processes, all incorporated flow production processes, and became large in the process. The secret was ever longer, synchronized, faster, automated flow production. Mass production, that's the mass production paradigm. But mass production had its own growing pains, which took from Adam Smith till quite late in the 20th century to sort out. To be efficient, each step must have the same throughput capacity, but step capacities want to be random. So chaos reigned inside these factories and in the distribution channels. Stuff built up. Work which should go through the departments rapidly gets held up at different places. If you see pictures of the late 19th century, you'll see a lot of junk piled up at different places in the factory because of bottlenecks. Congestion of unfinished works, high frequency of mistakes at rush times, shortages that must later be made up. We're not done with this world. This is the state of the Singapore Straits right now in container shipping. And it's because there's an imbalance in the supply chain and everybody's having to move their stuff around and the old routes are not working. So 13 container ships have been canceled in the last month because there's nothing to send. So what is it about synchronized flow production that creates these problems? Basically, they're not short a bunch of put options, they're short one but very different kind of put option. Their expected liability is this thing so N is the number of steps, Q is the planned throughput per unit time, C of Q is the average cost per step, which is a function of planned throughput. You need larger machines to put more stuff through. And E of Q min, that Q with a tilde is actually a capacity of each step, and it's random. And so when you get the expectation of the minimum of n random variables, you have an order statistic, and that's what you're short. Pardon my language, it sucks. From this option-based model, it's immediately obvious, if you recall the formula on the previous page, more steps mean more complexity, make things worse, and increases this liability, if you don't do anything about it. That's the dark side of the division of labor. More variation means less control. There's more spread for the minimum to be more minimal. And so you have less control and that makes things worse. So I want to say it is wholly rational to have extreme risk aversion in this world to the point of paranoia. And if you studied operations management as I did before the rise of platforms, then factory managers hated risk. We came in with option theories. You don't need to hate risk anymore. Well, they hate risk because the technology itself rewards prediction and very, very tight control of all the steps that are chained together this way. So the more steps, the more severe the problems, and the more control is needed. And the response of society was a series of actually very marvelous innovations, many of which came from MIT. Production control, inventory control, cost accounting, scheduling, planning, time and motion studies, vertical integration was the financial contribution. And there's a practice at which Intel pioneered called copy exactly or copy exact, where when they do a fab, and a fab can have up to 1,000 to 2,000 steps all chained together, synchronized. When they build the second fab, they copy everything in the development fab exactly, down to the rooms, to the, people say, the paint in the bathrooms. And this is the practice that it has spread through semiconductor fabrication so that TSMC has copy exact, all aimed at finding bottlenecks and or reducing variation, finding the capacity mismatches or reducing the variance. So efficient management of a flow process needs a particular organization design. Guess what? Ownership, unified, one owner. No extent, the entire process. You can't leave any steps out because that might be the next bottleneck. Locus of authority, one. Everything goes up to a single decision. You cannot have agency issues and transaction issues haggling in this kind of process. So an information flow, hierarchical. You've got to set it up so that it's rationalized. Why? This org design is all about control. It's about reducing variation. It's about not letting bad things happen because the only things that can happen are bad. So then everything changed, and I want to talk briefly about the rise of platform ecosystems. So a platform system is a technical system comprising a core of essential functional elements, the platform, plus a set of optional complements. The platform has no value except in conjunction with the options, the complementary options. The SIBO, as I learned to call it today, is a platform. And Ariane talked about their ecosystem. They are the center of a platform. In fact, all markets are basically platform ecosystems, all marketplaces. And this has been true back to ancient Sumeria. An ecosystem is a group of autonomous firms and individuals whose actions, decisions, and investments are complementary in the Milgram-Roberts sense of their value as a system is greater than the sum of the values of the separate parts. So each input makes the other inputs better. There's positive externalities throughout the ecosystem. So how are they different from synchronized flow production processes? The managers of large platform ecosystems are long a bunch of call options. Each trade on the SIBO is an option that needs a buyer and a seller, needs two sides. But they're options, and SIBO makes its money, I think, by taking some of the value in those transactions. The expected system value, and this is, well, the symbol didn't come through very well. P is a binary variable. Platform is there or it isn't there. And then everything that follows is UI is the number of users of each complementary option, the number of buyers, if you will, and then E, the MAC, that's a standard call option formula, well known. And these things, the platform, the number of users, and the value of each option, those are complements. If one goes up, it makes the others more valuable. Note that the value of an option is increasing in the risk. This is Merton, 1973, Proposition 8. In doing this work, I had to throw out probability distributions. So there is no probability distribution. Well, there's one late in the book, but because we don't have them in these markets. We haven't observed actually enough structure. So maybe we could next, when I'm dead. So that's the value of the option. And the value of the platform system, which gets divided up between the platform provider and the complementors, can be written as the number of options. The number of options is the number of complementors. The average number of users per option. And with apologies to Myron, who doesn't like averages, you can conceive of the average option value. So you can maybe, it's hard to do, but you could maybe calculate it. The thing to notice is a rise in any of those things makes the value better and makes the value of a rise in the other things better. So the deltas, and this is Milgram Roberts, the deltas are all work together. Monotone comparative statics is the technical name for this. And it's simply, one goes up, the value of investing the other goes up. Provable properties, I'll go quickly here. More options increase value because, as we all know, call options have no downside risk. More variance increases value because with the downside risk eliminated, the upside is good. Dividing any component into modules that can be mixed and matched increases value because more modules gives you a portfolio with more options. That's Merton 73, Theorem 7. Portfolio of options is worth more than an option on a portfolio. And this is important, opening a platform to more complementers, say, y'all come, increases value. So more complementers create more options, make a bigger and better platform system. What makes digital technology different? As in, why now? Well, computers or platforms are intrinsically platforms for computations. You can do theoretically any computation you want. And the specific calculations are determined by the user. And the more users, the better. The more the thing is worth. As it happens, this is due to Dan Whitney, who's a professor here. Electronics, hardware and software, are easy to modularize. Much easier to break apart than a car or an airplane or any of or construction projects, although construction's an interesting thing. Once modular, so once the system is modular, it's hard to keep it closed. Because if you went down to the tasks and transfers, what you would have done to the structure of them is you would create a lot of thin crossing points in that big blob. And those thin crossing points are points of low transaction costs because what flows across a thin crossing point is much simpler than what flows around in an interdependent system. So in the 60s, the IBM System 360 was the first modular computer system. We can date it. Markets have been modular forever. Buyers and sellers are not the same as owning the exchange. But the first modular product system was the IBM System 360. They had to invent how to do it, basically. IBM tried to keep that system closed, but it quickly started losing share to what were called plug-compatible peripherals, disk drives and things like them. In the 1980s, IBM, having learned a lesson, made the PC open and modular on purpose. So it was a strategic action, not a surprise, oh my God, what are we going to do about these PCP guys and all of our San Jose employees who are leaving us to start disk drive companies? So by then, IBM strategy had thought through something about large open platform systems. They didn't think through it all because they ended up with, and then in the mid-90s, the internet, which is not owned, but managed out of MIT, I think, created an even larger open platform system with more scope. So today, I just want to show you the 15 largest companies by market cap. The red ones are digital platforms, companies, Apple, Microsoft, Google, Amazon, NVIDIA, arguably, although they have a lot of flow production that goes on, although they're fabless, so they don't. Then Meta, Facebook, Visa, and TSMC. Berkshire Hathaway and Tesla are interesting because in different ways, Berkshire Hathaway, about a third maybe of its market value is its share in Apple. Warren Buffett has said Apple is a better business than any other he's been in, that Berkshire Hathaway is in directly. And then Tesla, Elon Musk, not my favorite person, has said that the latest Tesla is simply a computer on wheels. And then the autonomous drivable Tesla is, I think, going to be a neural network, or is a neural, and they are way, way, way out in the frontier, I think, of neural networks and also chip design, because what all of the top 5 companies, all down to Visa, well, and all except maybe Visa, they're all getting into chip design. They're all doing their own. So in a way, they're vertically integrating what they think is the most strategic layer of their system. So blue is part platform, black is flow production. Wrap up, real options are embedded in technology. We just need to tease them out. Synchronized flow production and platform systems have different real option structures. I want to call synchronized a bottleneck put option, because I couldn't find in classic option theory anything that needed the expectation of the min. So I figured give it a new name. And only here because no one who reads my stuff anywhere else cares about the options analogies. They need different organization design, different management systems, and different attitudes towards risk. Companies increasingly need to combine the two paradigms. So we have server farms, we have chip making, logistics, cloud computing. All of that is based on synchronized production. So it's really, it's harder and harder for a big platform company to not worry about flow production. Thank you.
Well, it's an honor to have been invited here to speak. And before I comment on Carliss's paper, I'd like to share what an important role the Black-Scholes formula has had on my life. I graduated from MIT as an undergraduate in '71 and Sloan 72, a year before the paper was published. And then I went to work for Citibank for 19 years. In 1983, my career took a detour from managing a lot of people to trading. And the head of the investment bank, for whom I had been the chief of staff, said to me, they just started trading these interest rate things in Chicago that they call options. You don't know anything about trading, but you went to MIT, maybe you could figure them out. That's the truth. And so I started by trading a proprietary book of interest rate options that morphed into the cap and collar business, the derivatives business, swaptions, the whole panoply of the big bad D word things. The market was not efficient, and the technological firepower of desktop computers was still embryonic, i.e., we didn't have computers on the trading desk. All we had was a Monroe calculator. So even for pricing interest rate swaps, we used a Monroe calculator, which is a bond calculator, and therefore assumed there would be payments at the end. And we knew it gave us bad answers, but we had no other tools, and so we used it. Now that was at a time, and Peter will remember, when in a market like swaps, not only was there a wide, very wide bid-offer spread, but you also could get a point of origination. So the fact that the calculation was a little off really didn't matter that much. And the same thing was true of options. When I started trading, there had been some caps done elsewhere, but we were the first people to do collars. And so we sort of knew that this had something to do with options. So we hired a professor from Boston University to build a Black-Scholes model. But there were a couple of simplifications in that model, which I share with you because I think you, and they're mainly academics, although some of you have both backgrounds, how we can screw up a really great academic idea by some oversimplifications. So we had this lovely model, and as the head trader, this model would take updated prices at the beginning of the day. And then head trader me had to make two decisions. I had a choice of were we in a high volatility environment or a low volatility environment that day, and were we in a steep yield curve or a not so steep yield curve. And I flicked those two switches, and that priced everything we did for the rest of the day, and of course informed our mark-to-markets, which is another story for another day. And we were among the more sophisticated players and the largest player on Wall Street at the time. So I just share that background with you because thank you guys, it really made my career. Now in terms of Carliss's paper, I actually didn't know Carliss, although we're only a year apart as undergraduates here, which is spectacular that we didn't know each other because there were 50 women in my class and 950 men, but we didn't know each other. Now, I have to apologize. I'm not going to do your paper justice because, first of all, I got a 112-page version of it, so I wasn't sure what you were actually going to talk about. And also, I really know nothing about the topic that you wrote about. But I will do my best to, I did read the 112 pages, and I have a few, not so deep, but a few comments to offer. One is that I thought that using options theory was actually very interesting to me. I mean, that was the part I found interesting. I wish there was a way to price it, because that's always been my angle, is how do you put a price on these things. I was also fascinated by your comments, which didn't come out in the version that you spoke to today, but you made a very interesting comment about how you had to consider the variation in the skill of the operator. And I haven't really thought through the full trading implications, but I think that probably has some implication. I've certainly seen among my clients people where there is a wide range in skills of the people who apply the same formula to the same situation and even the same trading style. So I think that has potential to be explored as to how we think about it. In chapter 7 of the document that I was sent, you discuss the decision to adopt a new technology can be thought of as an option to fall back on an old technology if it proves to be better, which I like the concept, but having lived in the real world, maintaining a technology and keeping it up to date is such a problematic. I can't tell you how often I do a lot of expert work and I have to go back and figure out what's going on a year ago or 2 years ago. And the systems just have not been updated. And so it's a good concept, but I think there's probably more emphasis needs to be placed on the cost of maintaining an older system and keeping it updated. It's not a matter of just maintaining it. You got to keep it live and you got to keep it moving along or it becomes obsolete. In your goal number 4, you mentioned that modularizing the options to support mix and match combinations. And I really smiled at that one because that was our undergraduate training here at MIT, was you got to take a big problem and divide it into little pieces, and the little pieces are solvable and the big problem isn't. So I really found myself drawn to that. And then I tried to think if there's anything I could say about the topic that you wrote. And the only thing I can really offer is, before I made the transition to the derivatives business, I ran a series of operationally intensive businesses for Citibank. The global investing division, the stock transfer division, the kind that had lots of people doing, they were not manufacturing in the classical sense, but it was a production of something. And at the time, the two production methodologies that people debated were some sort of straight-through processing versus a workstation, where you put people in a round thing and they talk to each other. And my only observation from that time, and again, this was a long, long time ago, was that the most important thing was to change your process occasionally, that you could get into a rut. And whatever approach you took, and there were pluses and minuses of the various approaches, but that the most important thing, not too often, because you could, but is to periodically reshuffle how you think about things, because that's the way you gain the efficiencies and insights. So I will give back the rest of my time, and thank you very much.
Thank you, Leslie. Your comment about the Monroe calculator makes me wonder what you could have done if you had a Texas Instruments. Questions from the audience?
It's late in the day. It's very late in the day. I'd like to.
Please.
I think I'm on mic.
Yes, you
are. So I'd like to thank Leslie for her comments. And on the topic of keeping technology up to date, this is a problem if the technology is changing rapidly. And the only way to do it is to modularize the system, which is expensive. And I'm telling you right now, most software out there is not, if you look at the task and transfers inside the program, not modular. And yet, the rewards to modularity, if you have high rates of technical change, are very high. The rewards when you have an unchanging process, you might as well vertically integrate, because the value of mixing and matching is not high. Anyway, but thank you so much, Leslie, for wonderful comments.
Question? Yes, can we get a microphone?
Hi, I'm Martha. I'm Rahl, graduate of MIT Sloan, and I work out in Silicon Valley now. And I read Carliss's first book, and I just want to give you a shout out, Carliss, about how many times I've thought about this modularity in tech. And this moment of thin information transfer, I wanted to give you the contrapositive story, which is we're partners with AWS, and they have a marketplace. And I think it's a sham. We think of the stock market, but what's really going on AWS Marketplace are vague pricing offers. And then big companies have commitments to buy AWS, and they get private deals behind the scenes. And other companies have bargains with AWS to sell product for AWS, and they get bargains. So I was talking with an investor who invests in Marketplace, and I described this, and I said, I just don't see the options and the connections and so on. Are we really seeing marketplaces? And it turns out in high-tech marketplaces that the information transfer point is valuable, but nothing else resembles this. The options aren't really exercised. It's an orchestration. But I could think through that because of your work. And so I just want to give you a shout out.
So happy.
Stu? A microphone?
Suppose you look at the car industry in 1910. It was modular.
Mm-hmm. It got less modular.
You had specialist engine manufacturers, specialist body manufacturers, of course, specialist tires. And a 1910 Cadillac or a 1915 Chevrolet was assembled from pieces, and it was entirely modular.
Yeah.
And then it changed. Why?
Because you could turn, to do synchronized flow production fast at large volume, you needed big machines and scheduling. And so when Henry Ford, when Carnegie's engineers put in place continuous flow steelmaking, the savings were monumental. He could.
It sounds more like economies of scale, which allowed the
Well, it's
modular.
economies of flow. Yes, so economies of scale go with economies of flow, but if all you think about is scale, you lose the interdependency. You lose the insight that option theory gives you into how all the pieces are tied together in a very, very tight way. But it's very efficient. So these flow production processes are efficient. You don't, if you do them well, think of Toyota, you don't have any work in process inventory. It goes way down. It goes from weeks to, in the US, when the lean machine came out, to minutes. And that's the goal. But in order to get those efficiencies, you really, really have to work on the balancing and the synchronization, because every piece of work in process inventory is an interruption of the flow process that takes advantage of the law of large numbers to say, well, these steps will be more balanced if we allow more time between steps.
Okay. Myron?
I have sort of two questions which are related. One is in terms of like the chain or Toyota, if you get synchronization, you lose flexibility entirely, because that's exactly to get the lowest cost solution. Then do you end up in a false positive world, in the sense that what you do is, or false negative, is that basically what you do is end up with no volatility, say, in the extreme of what you're doing, and then the chain breaks, okay? It's so taut that there's basically, so you have because anything you don't anticipate has a huge cost on you relative to having enough uncertainty along the way to dampen the.
And you know, that's why the two types of technology, although I hold them out in opposition to each other, you really need them both. You need the flow processes inside the options. And so it's really a question of how and where do you break the sequence, and how much stuff do you put between the two? I mean, this is an airline problem. How much of a buffer do you have in the air network between the flight coming from Los Angeles and the flight that same plane leaving Chicago? And depends on weather and things, but it's a decision they have to make.
Wait, Peter?
I want to just also shout out to Carliss, who I was fortunate to meet through Bob about 25 years ago, and I wish I'd met you before I took on management responsibilities at JP Morgan, because your concepts would have been enormously helpful in the decision as to what to modularize and what not to, because I had mature businesses like the bond businesses to manage, which had been around forever, and then the emerging over-the-counter derivatives business, which was changing fast, where modularity was really helpful, and knowing where modularity made sense and where it didn't. One observation I'd make from the outside in, looking at market structure in the financial crisis, was that the over-optimization of securitization meant that a process to squeeze every last drop of arbitrage created fragility and complexity, where any single securitization might have 8 tranches, and that created this rigidity of the flow.
Yeah.
And then subsequently, I think we lost a little bit of the benefits. Come back now, but I think that, you know, in my most recent corporate life at AIG, we did a lot of very simple securitizations, just senior, junior. And yes, there was a little bit of arbitrage left on the table, but to me that was an optimal modularity point. You could get 80% of the benefit while retaining a lot more flexibility, because if you ever had to restructure it, you didn't have to go to 8 different stakeholders and persuade them to repack
Yes.
the stack.
There's something to be said for a very clean,
Keep it
fast
simple. Exactly.
decision-making process,
So
which is.
I found it really helpful. Thank you.
So thank you, Peter. You know, today we have a new value out there in the real market, in the real world, called resilience. With COVID, this Singapore thing going on now is but the latest example of disruptions in very tightly integrated supply chains. And, you know, and now things are turning around, and we need that resilience and flexibility that comes from creating modules and buffers.
Other questions or comments? Okay, Ben, and then Myron.
It would seem that when you can generate, I think you call them complements.
Complements, yes.
It would be, as the transactions costs associated with interjecting a third-party product versus your own manufacturing would be something which could change through time as efficiencies at different parts of the system evolve. So if you can suddenly synchronize your delivery to your, if a supplier can do that, you're more amenable to that. And that gives them an advantage. If scale becomes an issue, the supplier who can, you know, like if you're an Intel functioning at a certain scale, no one's going to try to create their own chip, or they do that at great peril. So I grew up in the Oliver Williamson kind of mindset that it's all fluid depending upon just the efficiencies, and what you can do physically is what you do when you can't do it contractually.
Okay, I could start on a long rant about Ollie Williamson, and you know, Williamson completely ignored technology. He made no, you know, his theory was there was this thing called mundane vertical integration, but that otherwise every process had lots of places where you could place transactions. And so the only drivers were, you know, asset specificity and you know, basically transaction cost drivers. So it's a good theory, but it is, I don't know if on purpose or just, he left out all the distinctions between different types of technology to create a theory that was applied to all technologies, except, in my view, he left some stuff out.
Myron?
Say this in a way that people are not going to call me behavioralist, which would be a disaster. But what I'm going to say is, in your thinking, what is the idea of using bad Bayesian updates in what they're doing in terms of how the decisions are made? Because if the process is not constant and changing all the time and subject to change, that you get bad Bayesian estimates. Or in other words, look at it between the Bayesian and the information theorist. You know, everything looks harmonious, and then they take actions because it is harmonious, which turn out to be not harmonious, and you get either from the information theorist person, where discord is so important to think about how you do changes. So how do they trade off the information theory, or the Bayesian view of the world, and updating view of the world with the discord view of the world, and the information theorist view of the world?
So I'm gonna take that on a tangent. I think our ignorance about the real underlying structure of the technologies that make our world is de minimis. We don't map technological structure. We have very coarse theories because it's very expensive when you've got many tasks and many transfers. You know, Steve Eppinger from here sends, you know, teams of 5, 10 students out to a factory to get one map. It's too expensive.
Okay, Bob?
I just had a very quick question, because otherwise it'll be a very long one. but in your emphasis on technology and change, would you say that this a candidate for the value premium is that companies that have these kinds of risks that you're talking about because of the technological, among other changes, that's a systematic risk in a sense that.
So are we talking about value capture?
Yeah, I'm just talking about the value. You know,
what do you pay up for?
If I haven't built a factory, if I have an option to do something later, and the world changes, I'm in pretty good shape.
You are.
If I built everything as a factory, so I'm generating a lot of cash flow relative to the value of my firm, because of that, if I was listening to you and your comment about technology not being considered in the aspect, I was just wondering whether that was a potential systematic risk. This is really a question.
No, and I think systematic is the wrong frame.
I mean non-diversifiable.
If you break the technology up, you will find inside the technology technical bottlenecks, which are technical problems that have not been solved, that need to be solved to take the system to its next level. Production bottlenecks are technical bottlenecks. You solve them with engineers. You will also find strategic bottlenecks, which are modules of tasks and transfers that are essential to the system, essential, unique. There's only one of, I really mean only one, and owned by a for-profit entity. And so this theory of technology points you not to trying to estimate not to trying to estimate the portfolio. Don't think of this as a portfolio. Think of it as an interrelated system with interesting points in it that are bottlenecks, technical or strategic. So it's really hard for me to bring it to the CAPM. I can bring it to option theory, but I can't bring it to the CAPM.
Because of the nonlinearities.
I was hoping I would get.
Yeah.
Anyway, thank you.
So we're out of time, but I'm going to take the MC prerogative, the option, to just make a couple of comments and then close. So one comment is that, Carliss, in your list of the companies that had modularity and platforms versus others, you have Eli Lilly in black. I would argue that Eli Lilly is a platform system. It didn't used to be, but I think modern day pharma, and Judy can confirm this.
So Andy, when I labeled the colors, digital platform.
Okay.
Eli Lilly is not a digital platform.
Right, but it is a platform of another kind. It's a biotech platform.
It's a tech platform for sure.
Right.
And it also has a flow production process.
Right. Okay. The other comment I want to make is that you mentioned that you really can't use real options quantitatively, empirically, because we don't know the distribution. I've had this.
We don't know the structure.
We don't know the structure, but in particular, you need a distribution in order to calculate the value, right? So I've had this debate with a number of colleagues about not knowing the distribution. When you tell an econometrician you don't know the distribution, that is a challenge that I believe we can meet. Because if you really don't know anything about it, and we've had this discussion, I asked them, can you tell me anything about the distribution? No, I don't know anything about it. I'll say, fine, it's uniform. Mm-hmm. And they say, well, no, it's not uniform. It's probably got a peak. So then you lied to me. You do know something about it. The point is that even if you don't think you know something about it, you'd be surprised at how a lot of these non-parametric techniques can tell you what
take up the challenge. Yeah. But I'm going to say you need the right unit of analysis.
Right.
And right now, people don't spend money to get the units of analysis right.
Yet.
Once you have the system broken down into its functional components, I think you could do maybe some pretty interesting things.
For the next generation of researchers out there, I think this will be a lovely topic. On that note, thank you very much, Carliss and
Thank
Leslie.
you.
We're gonna take a break. We're gonna reconvene in about 10 minutes. We're gonna have a panel discussion about applications of Black, Scholes, and Merton and the financial, regulatory, and policy landscape. And then after that, we're gonna have a fireside chat with Paul Salmon and Alethea Black, at which point we're gonna turn it over to Bob and Myron for the last words. All right, so let's reconvene in 10 minutes.